Welcome to the Drill Down, in-depth answers to oilfield questions. I'm Richard Spears. Today is a special program because you are about to hear a recorded conversation between my brother and I at an event hosted on the 8th of December 2020 at noon, where the SPE Gulf Coast section and the API down in Houston had their annual meeting, and they invited my brother and I to talk about the rebuilding of the American oil field. If you are watching this on YouTube, we invite you to hit the subscribe button. And if you are listening on Spotify or Apple Music, we'd like you to hit the follow button. Anyway, listen to this live recording between John Spears and Richard Spears. We hope you enjoy it.
Generally speaking, oil companies and oilfield service companies have done a very bad job of returning profits to their investors.
And by very bad, we mean they don't. That's an overstatement.
I've seen other. It depends upon how you want to measure. Do you use median versus average and so forth? But I've seen lists that said out of 110 industries, the oil industry has been a number 100 on the list in terms.
That would be bad.
That would be bad. Way down low. So
because my favorite parallel is the tobacco industry, which 20 years ago just got kicked in the teeth by saying you're killing everybody by making them buy tobacco.
Any number of lawsuits about,
And as a result, if you were an investor, you dumped your tobacco stocks.
Yeah.
Well, tobacco, turns out that you can sue them, but there's a lot of people that still like to dip a little snuff every once in a while. The entire Major League Baseball organizations. And so the tobacco guys pivoted and said, we're going to be a dividend-paying machine here, right?
Oh, absolutely, right. If you look at your average tobacco company, it pays half of its net earnings in the form of dividends back to its shareholders. Right?
So I'm an old retired guy.
Right.
I want to get a big dividend payment. I really don't care what the value of the share is. I do, but I want a dividend payment because that's what I live off of.
Right.
So tobacco is a place to go.
Yeah, and then if you look at how stocks have done since the late 90s, tobacco stocks have had a wonderful run. I mean, they've been for a long time they were among the highest performing sectors out there. So that had attracted a certain amount of investment back into those stocks because they just provided some excess returns, I think is what investment guys would say. So that's the challenge, I think, for the oil patch these days, isn't it? Right?
Because what do you think our dividend return has been?
Well,
for the oil industry?
Yeah, so it's been a mixed bag. It was absolutely terrible prior to 2018.
But it was terrible because the investors wanted growth. Well, if you want growth, you take every nickel you've got of spare cash and you put it back into making the thing bigger than it was.
Yeah.
Whether you're an oil company or a frac service company, drilling contractor, don't pay me a dividend, give me growth.
Yeah. So,
but then they changed.
Right. So management was all about production growth, right? And profits were sort of an afterthought. And so, 2018, 2019, there was progress back toward to what it needed to be. This year is not going to be measured in form of progress.
We can't use this year as anything.
But if you look at the average company on Wall Street, they return about 15% of their net earnings is paid out in the form of dividends. So, right? Last year,
how much was
about
that?
15% of their net earnings are paid out in the form of dividends.
And that's the average.
That's an average, right?
For all industries.
Across all industries.
All right.
Last year for the oil patch, the number was 7%. So we were half the rate of all industries. We'd been even less than that in 2018. So we were moving in the right direction.
So wait, 7% was our improved position.
That was our improved position. We had to double that just to get to the average. And my point would be that given the volatility of this industry, given the outsider nature that we enjoy among investors now, we probably have to go well above average in order to have investors fall back in love with us. I don't know that we have to, the tobacco industry is roughly 3 times the average in terms of its payout rate. So I don't know that we have to go from half the payout rate to 3 times, but we've got to get better. And that's going to take 2 or 3 years, I think, for the average oil company here to do. Yeah.
So that's going to be then the last question we've got here, which is, and by the way, then we're going to go to Q&A if anybody has a question.
Right.
And I don't know how we're going to do that, but we'll figure that out.
Yeah.
But it is that to attract or re-attract investor interests,
Right.
then the oil and gas industry has to get to a, not just average,
Right.
but something above average.
Yeah.
And it's not going to be overnight.
Right. So the challenge is that as an industry here in the U.S., depreciation's about $100 billion a year in the upstream sector. So oil companies as a group collectively have on the order of $100 billion worth of depreciation. You add back what their earnings are and so forth, and you have a little bit more than $100 billion in free cash flow.
Well,
in a normal year. Right.
And would a normal year be like starting right now?
Or last year, so forth. So 2020 is, not
normal. The rest of 2020,
yeah,
but like where we are now.
Yeah, so if you thought going forward, you'd say, okay, just for planning purposes, we might think as an industry, we've got on the order of about $100 billion of free cash flow. We have no access to outside capital in the form of lending or equity.
In fact, I got a lot of debt sitting there.
Right. As an industry, we have something on the order of $450 billion worth of corporate debt out there.
A little too much.
A little too much. So, so the question is, what do we do with our $100 billion, right? Next year, we're going to spend about $40 to $45 billion in terms of new wells and fracking and so forth.
All right, not quite half.
Right, not quite half next year anyway. So that leaves us roundish $50 billion that we can pay down debt with and increase dividends with and so forth. So there will be money next year, and I think we'll certainly see progress in terms of deleveraging oil company balance sheets.
That means paying down debt.
Paying down debt, yeah.
So I'm going to take some of that $50 billion,
right,
and I'm going to go give some of it back to my banker.
Right, exactly. Yep,
and
absolutely.
say, don't drive me into bankruptcy. Here's some money.
If I think beyond 2021, in order to sustain output, we're going to have to start drilling more wells, and so because right now we've drilled a bunch of wells that are in the uncompleted category, we get to take some advantage of work in progress. But after 2021, the industry is going to have to start spending more money, $60 to $70 billion a year, in order to hold output steady, maybe increase it a little bit. $100 billion of free cash flow for planning purposes. So now the industry is going to be putting about 70% of its cash flow back in the ground and using about 30% of it to delever. So I think that's a sustainable.
Man.
I think that's a sustainable.
But where's the dividend?
Well, the dividend is a part of that $30 billion. That, again, portion of it will go to deleveraging. Part of it will go to shareholder returns.
But but just to be super clear, the industry can sustain debt, and it will sustain debt. You don't unleverage. You don't unlever. You delever.
You delever. Right.
You reduce the amount of debt. You don't make it all go away.
Yeah.
Because that would.
Again, just on big picture status, the industry right now, its balance sheet is about 50% equity, roughly, for the industry as a whole. So the notion is that debt piece has to come down some. And that's what the next 2, 3, 4 years are going to be doing, I think. So, but again, that can happen with a $45 to $50 oil price. We don't have to see prices go back to 100 in order to deleverage this. I think the way things are set up now, we can begin to make progress there. So,
we are here on this call, and we're going to turn to the questions here right now, Robert. So figure out how we're going to do that. But we're an industry that hopes springs eternal, that the price will go right back to 100 at some point. We'll all be rich.
Yeah.
That works really great for us for about a year or two, and then it's a complete and utter disaster. But when I look at these metrics, I see an industry that globally is pretty disciplined for now, anyway. I see a banking industry that hasn't completely given up on us because they haven't called all their loans. And I see a set of management teams really all over the planet who are doing a pretty good job about trying to make things the right size. So again, some of the oil companies in the United States and internationally have been slow to right size their organizations.
Mm-hmm.
They should have done it faster. The oilfield service companies, they're done already. They're the right size where they need to be for the business going forward. Yeah. So when I look at the green shoots, I think things are good for the service companies,
right,
in terms of like employment and growing revenues and hopefully putting a little money to the bottom line. There are probably some adjustments still need to be made with their customer base.
Right, yeah. The service guys had a very tough second and third quarter because I think many oil companies, out of an abundance of caution, really cut back on their CapEx activity because they weren't sure what their revenues are going to look like and what their cash flow is going to look like. So they've been able to sort of release the brake here, and the fourth quarter has seen rig count go up, frac activity rise, and so forth. So part of that is just we're past the worst, and that's why we see this improvement going on in the service side of the business here in North America.
You know, when you see earnings released for the fourth quarter,
so
mid-January, 1st of February,
right,
for the purely domestic oilfield service companies, surprisingly good earnings. Growing revenues, money to the bottom line. I think it's going to be surprisingly good. For the international...
Because expectations were
they were always so low. But the fourth quarter, the third quarter saw the uptick. The fourth quarter is very much a real uptick. And but the international service companies are still in global adjustment mode downward. So the big guys don't do as well as the domestic folks.
So we'll have a lot of moving parts yet, but generally speaking, the movement is in the right direction. So,
all right. So we're going to go to Q&A. It's at 12:30, and we got a few more minutes open. Do we have anything that's come in, Charlie, typing, or is it?
No, I think we'll toss.
Can you guys hear me?
Yeah, we can now. Yep.
Yeah.
You can hear me?
Yep.
Okay. So I'm going to take this microphone around and let anyone ask questions who can. First of all, guys, thank you very much for the presentation. I mean, this is great. You come to an API SPE oil industry luncheon, and you learn about tobacco stocks.
Yes.
And I learned about watermelon seeds.
I can't wait to check that out. Any questions?
Thank you. My name is James Berry. I'm with TurboChem International, and I hate to ask an international question at a Houston Energy luncheon, but what are your thoughts on the Aramco IPO and guaranteed dividends and its effect on the money that might go into our domestic industry fleeing for foreign shores, and similar investment opportunities overseas, guaranteed dividends that you were discussing earlier at a much higher rate than standard?
Yeah, you want me to go first? Yeah.
Well, just so that I can have a longer time to think about it. But you know, if you look at those 300 clients that we have, Saudi Aramco is one of our clients. In fact, they're a very, very good client. And if you look at how Saudi Aramco has used our services, it's not to help them figure out the Middle East market, because they are the Middle East market. They use us to look at the U.S. market and figure out how do you guys do it here. Right. And if you see what Saudi Aramco has done over the last, and Kuwait and Qatar, it is the Americanization of their oil and gas industry. So, it's locally owned, multiple service companies.
So the supply chain that those companies are using now looks a little bit more like the type of supply chain we have here
in Odessa, Texas.
Right, there you go. Well, so for those who followed the Aramco IPO, in that IPO, one of the things they committed to was a dividend payment of about $75 billion a year, roughly 18 or 19 billion dollars per quarter. And they did so because, again, while it's publicly traded, the Kingdom of Saudi Arabia owns something like 98% of the stock, and the kingdom is highly dependent upon those Aramco dividends to fund its federal budget. So that's why it was it was enlightening to see, because Aramco had to go borrow money in the third quarter to make that $18 billion payment. It borrowed, I think they said $5 or $6 billion in order to do that. So, and at the same time, what did we see happen on the service side? They dropped spending like a rock, right?
Drilling activity dropped by 30 or 40%.
Yeah, and
almost overnight.
Yeah, and if you recall, during the previous cycle, 2015, 16, 17, rig count in Saudi and throughout the Middle East was steady as she goes. So this has been, in my mind, an instance where perhaps because of the IPO, Aramco is now beginning to behave a little bit more like every other publicly traded oil company out there.
It
right?
looks just like
It's got the same issues
Devon.
ahead of it, right? How do I pay a dividend to my stockholders? How do I balance CapEx and so forth? So I think the other part of the impact is because they have dropped rig activity. The question will be what will happen to their production capacity going forward. Aramco has always kept, a fairly large surplus out there to bring in and out of the market to sort of balance prices. And I'm not sure that, if it's beginning to think like Exxon certainly doesn't keep a surplus, a cushion out there, right? And so I think that will be that'll be interesting to see how that moves for that company and some of the other big national companies in the world.
you can borrow to pay your dividend for one quarter,
a while,
and you might be able to borrow to pay your dividend for a second quarter.
but at some point you have to.
You've got to stop.
Spending. You just have to adjust your spending. Yeah, absolutely. So, so a lot of the countries in the Middle East, in order to balance their federal budgets, need an oil price of $60 to $70 a barrel in order to do that. So that gives us a marker anyway as to where the major players would like to see oil prices going. Yeah, I hope that answered James's question. So,
Ask him. He said it did.
Okay, good. Thanks.
Anybody else? Got one coming.
Okay. What I want to know, or just get a comment on, is you talked a little bit about the new administration, and they're going to be more green. So, in your opinion, do you think that they're going to actually push for cheaper oil prices or much more expensive oil prices? Because my contention's always been that the environmental movement wanted oil prices as high as they could get them, so that the renewables could compete. So I'd like to hear what y'all think.
Oh, you're spot on.
Yeah,
What does better for conservation than a $300 a barrel oil price?
Oh yeah. So that's a very good point. And generally speaking, the economists would agree with that, right? But I think the other aspect is that of force conservation. So there we see a push toward higher and higher fuel economy standards, for example, from automobiles, so that we use less gasoline rather than price it higher. The European approach has always been a high price, right?
Yeah, where the tax part is 75% of it.
Yeah. I think the other aspect, and this is going to be just the irony for 2021, is we'll see CO2 emissions in the U.S. skyrocket. Part of that will just be because we have a better economy. But the other part, I think, too, is if natural gas prices rise, then the power plants in the U.S. are going to switch away from gas back toward coal. There'll be some pickup.
Wait a minute.
Employees. Yeah.
What'd you say?
Yeah, higher natural gas prices. And again, that's part of the issue here, right? Environmentalists might like higher oil prices to discourage the use of oil. But if you ask for higher gas prices, you'll end up with more coal use, right, in the power sector. And that just leads toward more. And again, think about what it is we have here with all these shale wells we drill and associated gas production. We get a lot more oil. We also get a lot more gas. So higher oil prices have resulted in lower gas prices
because I got plenty of gas,
and vice versa, right? So that's the issue that of balancing this is if you want higher oil prices to discourage oil use, then you might get a lot more gas too, and that could help you. But you'd have to do a lot of fracking in between. So there's you pick the poison that you want to have.
Well, and what better if you can make your enemy a hated enemy? So right now, people go to fill up their gas tank, and they don't even have an opinion about an oil company because it's so stinking cheap to fill up your Ford F-150 or your old whatever you drive. It's old, whatever it is you drive. It's hard to be mad at the oil companies because it costs you hardly nothing to fill up your gas tank.
Right. Yeah.
So
unlike the cable bill, for example.
Well, I hate Cox cable.
Right, keep going.
But your point is so right. If you can figure out a way to get them to hate the oil companies, then they'll back you for whatever the alternative is.
I see. So if gasoline is a high cost item, then
if it's $4 a gallon, give me wind farms. I don't care how much farmland that covers.
So the Biden administration has one of its green points is to make the power sector carbon neutral. So it's not going to eliminate the use of fossil fuels, but it does want to
somehow,
if
it comes out here, it needs to go in there.
By 2035. So we've got 15 years to reach the promised land.
Go.
And so there's a lot of technology that needs to be developed for that. And that's actually, I think one of the things we hear more about next year is the fact that we may want, green energy supply, but do we have the supply chain that we need, and is it secure, that would allow us to achieve green energy? So do we have the access to the minerals that we need to build electric vehicles, for example, things like that? That's going to be a real issue as this push regarding clean energy. Yeah.
My new Winnebago has a lithium power system in it.
There you go.
So I'm vulnerable.
You're ready. You're set.
Anything
But thanks
else?
for the question. Yeah, absolutely.
Do we have anybody else?
Mm-hmm.
Man, you guys are so good. We just don't have that many questions.
Well, we lull people into submission.
Hang on. I think we may have one from online.
Oh, good.
Oh.
Can you comment on carbon capture and the impact on the industry?
A little bit. So this has been an effort that we've seen several European firms sort of take the lead on. We first did a study on carbon capture and storage almost 20 years ago now, and that there's hardly been any progress in terms of commercializing that service yet. It's just extremely expensive to capture carbon from an industrial process where you're cleaning up smokestacks or power plants and so forth. And then you have the attendant issue of transporting it and pumping it downhole and all the rest of it. So it just becomes a high cost type of solution. And so at this stage, I don't think it's anywhere near, it's only to the sort of the pilot demonstration stage in so many places, and not really a factor in cleaning up the environment. Now, that all being said, one of the things that 2020 has unrolled is the number of major oil companies that now want to take a significant portion of their CapEx budgets, 25 or 30% typically, and put that toward renewables type investment. So sometimes it's wind and solar, but sometimes it's things like carbon capture and storage. And so that'll probably advance the ball down the field a lot faster than the way it's been moving. The other thing it's going to do, though, that means there's, again, less money. If you say the oil industry won't have much access to outside capital to go drill and complete wells, and now you're also taking away some of the internally generated cash on the part of the big companies and putting it toward renewables. Now there's just going to be less money going into exploration and development. And so down the road, the market will tighten, and that will have an effect on prices. So our second question about higher oil prices may come about even if the environmentalists don't intend it to happen. So
to handicap your projection, the
Right.
price of oil, 18 months from now.
Right. Yeah.
Would you say that there's a greater chance that it would be above 50 or a greater chance that it would be below 50?
I think, no, above 50, I think it has the greater chance. I would be willing to say it could be 18 months from now, a $60 price might be in the rearview mirror. So.
And just for the record,
Yeah.
for those people who don't know you, you are not an oil price bull.
No, there are others that are more bullish than I am.
And
Yeah.
like others, there's like trainloads of people who are more bullish.
Well, I tend to be cautious on this because, things can happen, right? And one of the things we don't know is how fast, after all this pandemic, how fast economies are going to come back. Because, for example, about 8%, on a global basis, about 8% of the oil we use is for aviation fuel, right? And the aviation industry is way off. And
3 airplane flights this year.
Yeah,
That's me.
And so it's going to be a while, for example, for that sector to come back, and that's a significant 8%. It's not chicken feed in terms of oil use. So how fast things recover and do they get back to the way they used to be is an open question. So I'm willing to be a little bit more cautious on oil prices than some are.
Hey, my brother and I are going to need to turn our attention to another thing. We've actually scheduled a second talk that starts in a few minutes, and I got to go eat an apple or something, otherwise I'll fall over. But does that help today? I hope it does, because first off, we are in the industry for a long time. We're in our 56th, 57th
Something like that.
year.
Yeah.
We've got our partners in Houston and Fort Worth and in Owasso, Oklahoma, and on a farm up in Missouri. We're just always glad that we were able to keep everybody employed who worked for us this year, and surge into the coming year, hopefully, just a tiny little bit better than we are now.
Hey, Richard.
Yeah.
Real quick, there's one more question.
Sure.
Can you address it just real quick?
Yeah, I'll read it to you.
Can you tell us a little bit about how the DUCs are counted, and is the number that we see from the Energy Information Administration an accurate indicator?
That's
Okay, that's going to be yours.
That's my
'cause you argue about this all the time, and the short answer is
Yeah.
no.
Yeah. So DUC drilled but uncompleted wells, for example, if you look at what the Energy Information Agency says today, we've got 7,000+ of those just waiting, and I don't have a lot of trust that number is accurate, because I suspect that it's affected by how quickly data gets reported to the various state agencies.
Which is not an immediate thing.
Absolutely.
It's lagged forever.
Yeah, right. Now, what we do know is that if you're drilling a well, and we talk about this, so you start drilling a well on a pad, on a multi-well pad. So the drilling of the wells on that pad will typically be a month or more.
Well,
right?
longer. Yeah. These days, because I drill 5 wells on a pad,
Right.
that could take 2 months.
Then typically we see several months go by while the surface infrastructure is put in place. So flow lines, stock tanks, heater treaters, whatever they need, right?
The first 20 million pounds of sand.
Yeah, that's right. And then the frac jobs begin on all those wells, and that's typically at least a month to get all those wells fracked. And then at that point, the wells get put into production probably a month after the frac job. And so it's easily 6 months' time for that we routinely see between the start of drilling and when a well gets put on production. So there is a long, there are quite a number of wells that are drilled but unhooked up.
Unhooked up.
Yeah. But I don't know that there's been a lot of them that have been deliberately drilled and then, well, we're going to wait and complete it.
Some,
when the price
but not
gets up.
not
Yeah.
a standard practice.
Yeah, right. So I don't have, like, so the question was asked, how's it put together? I truly don't know how many uncompleted wells are out there just waiting to be done. And so I have. It's hard for me to have a lot of faith in what that count is. But you know, we will see. We at some point we will have to start drilling more wells in order to sustain output at an 11 million barrel a day number. So,
But that is not between now and next summer.
not between now and next summer. Now, for the next several months, for a few more quarters, we'll still be able to sort of work off a bit of that inventory that was left out there when we cut rig activity so much, and then it goes away, and we'll be right back at it. But thanks for the question. I appreciate that.
Thanks, guys. Okay.